Two people, same amount of money, same starting point. 20 years later, one of them is exhausted and the other one barely noticed time passing. And when you look at the actual numbers side by side, what you find is going to challenge almost everything the internet has told you about building wealth. Let's set this up properly. Two friends, Ryan and Daniel, both have $50,000 saved. Ryan uses it as a 20% down payment on a $250,000 rental property. He locks in a 30-year mortgage at 7% interest, finds a tenant, and starts collecting $1,800 a month in rent. His mortgage payment sits at roughly $1,330. On paper, he's pocketing nearly $500 every single month. Daniel takes that same $50,000, drops it into a broad market index fund, sets up an automatic $300 monthly contribution, and essentially forgets about it. Day one, Ryan has a physical asset, a tenant, and a sense of accomplishment that feels impossible to argue with. Daniel has a confirmation email, but here's the thing about feelings and math, they rarely agree. The first few years look great for Ryan. Rent hits on the first of the month. He's building equity with every mortgage payment. The neighborhood is appreciating. He claims depreciation on his taxes. Everything feels like it's working. Daniel's account ticks up quietly. Year one, 50,000 becomes about 55,000. Year two, maybe 61. Nothing dramatic, no story to tell anyone. But let's talk about what Ryan's actually keeping, because the $500 monthly profit number is the one everyone brags about, and it's also the one that's almost never real. Property taxes on a home like this run around $3,000 a year. Insurance adds another $1,500. Budget 1 to 2% of the property value annually for maintenance, and you're looking at $2,500 to $5,000 in repairs, some years minor, some years a $7,000 HVAC system that can't wait because it's the middle of summer. Then there's vacancy. The average rental sits empty roughly 1 month per year. That's a full mortgage payment with zero rent coming in, plus cleaning costs, relisting fees, and time. If Ryan manages the property himself, he's working a part-time job without a paycheck. If he hires a manager, that's 8 to 10% of rent gone every month. And nobody wants to talk about bad tenants, but a tenant who knows the eviction process can cost 3 to 6 months of lost rent plus legal fees. That one event alone can wipe out an entire year of profit. After 5 years, Ryan has dealt with a roof replacement, a plumbing emergency, tenant turnover, and rising insurance costs. His real cash on cash return after every actual expense is somewhere between 3 and 5%, not the numbers he was expecting. Daniel, meanwhile, has done nothing except not interfere. By year seven, his portfolio has grown to somewhere around $135,000 to $150,000, including contributions. And here's what's happening underneath that. Compound growth is starting to accelerate. The returns are now generating more new wealth each year than his contributions are adding. At the 10-year mark, the comparison gets genuinely interesting. Ryan's property has appreciated to roughly $335,000 to $350,000. With his remaining mortgage balance around $166,000, his equity lands somewhere between $170,000 and $185,000. But he's also spent $20,000 to $35,000 out of pocket beyond his down payment in real costs over that decade. Daniel's portfolio sits at approximately $165,000 to $180,000. He contributed $86,000 total. Everything beyond that is pure compounding. He hasn't replaced a single appliance, handled a single tenant dispute, or answered a single late night phone call. At 10 years, they're surprisingly close. Ryan might be slightly ahead because leverage is genuinely powerful. Using $50,000 to control a $250,000 asset is something index fund investors simply cannot replicate. That multiplier effect on appreciation is real, and it's the reason real estate has created enormous wealth for people who do it right. But now watch what happens over the full 20 years. Ryan's property is worth somewhere between $450,000 and $500,000. His mortgage is paid off or nearly there. His equity is substantial. But after 20 years of maintenance cycles, roof replacements, capital expenditures on appliances and systems, vacancy periods, and renovation, his total net cash flow profit above all expenses might be $40,000 to $80,000, possibly more in a strong market, possibly less in a flat one. Daniel's portfolio, at a 10% average annual return with consistent monthly contributions, has grown to approximately $420 to $460,000. He contributed $122,000 over 20 years. The remaining 300,000 plus came entirely from compounding doing its quiet, patient work. No debt carried, no concentrated risk in one zip code, full liquidity at any moment. The net worth numbers at year 20 are actually similar, but how they got there is completely different. Ryan worked for his, Daniel waited for his. One path required hundreds of hours of active management, significant debt, and all risk concentrated in a single asset. The other required discipline, consistency, and the psychological ability to leave it alone during downturns. And that last part is real risk for index fund investors. Markets drop hard and fast. When that happens, most people panic and sell at exactly the wrong moment, turning a temporary decline into a permanent loss. That's the behavioral trap that ruins the strategy for people who can't hold steady through a crash. Here's what all of this actually tells you. Neither path is automatically superior. Real estate wins when the rent to price ratio works in your favor, when you treat it like a genuine business rather than passive income, and when you use strategies like house hacking or tax deferred exchanges to maximize every dollar. Index funds win when you value your time, need liquidity, want diversification across thousands of companies, and can stay consistent without touching it during volatility. The real mistake isn't choosing one over the other. The real mistake is picking either one based on what sounds impressive without ever running the complete numbers for your specific situation. Not the headline numbers, not the gross cash flow, the actual, fully loaded, total cost picture over 2 decades.
So before you sign a mortgage or set up a brokerage account, ask yourself one honest question. Have you included everything? Because the answer that includes everything is the only one worth building your future on.